Most property investors believe that comparing nearby zip codes is a smart and logical way to choose where to invest. It feels safe. It feels rational. But this simple assumption quietly destroys investment outcomes every single year. Two zip codes can look almost identical on the surface, with similar homes, similar streets, and similar price ranges, yet perform completely differently over time. The truth is, location similarity does not equal investment similarity. And this mistake alone can cost investors thousands in missed growth and poor decisions. This is where most people go wrong. The most common mistake is assuming that proximity means similarity. Investors often compare zip codes that are next to each other, believing they will behave the same way over time. This includes comparing suburbs within the same city, or areas that look equally developed and attractive. But property markets do not follow simple geography. They follow demand patterns, income growth, supply constraints, and long-term trends that are often invisible at first glance. As a result, two neighboring zip codes can move in completely different directions, even over many years. This happens because each zip code has its own underlying drivers. One area may benefit from strong job growth, better infrastructure, or increasing demand from higher-income buyers. Meanwhile, a nearby zip code may face oversupply, slower growth, or weaker long-term demand. These differences are not obvious when simply looking at houses or prices. Over time, this leads to a widening gap in performance. One zip code quietly outperforms, while the other lags behind, even though they appeared similar at the beginning. The real danger is not just choosing a bad investment. It is choosing what looks like a good investment based on flawed comparisons. Many investors believe they made a smart decision because the area looked strong relative to nearby zip codes. But over time, the performance tells a different story. Slower growth, weaker demand, and missed opportunities begin to add up. By the time this becomes obvious, it is often too late to adjust without taking a loss. This is how small mistakes turn into expensive outcomes. The correct approach is not to compare zip codes based on location or appearance. It is to compare them based on actual performance data over time. This includes long-term price growth, consistency, and how each zip code ranks relative to others across the country. When data is used properly, the differences become clear. Strong markets reveal themselves, while weaker areas become easier to avoid. This removes guesswork and replaces it with a structured way to identify real opportunities. At RegionMetrics, we focus on helping investors avoid exactly these types of mistakes. Instead of relying on assumptions or surface-level comparisons, our data shows how each zip code has actually performed over time. This makes it easier to identify strong markets and avoid underperforming areas with confidence. If the goal is to make better property decisions using real data, exploring RegionMetrics can provide a much clearer perspective. Thank you.